Welcome to CEO Connect, presented by CU Solutions Group. On this month's episode, how technology helps credit unions disrupt the market to serve the underbanked.
As credit union boards and executives refresh their strategic plans this year, some will take a similar approach to what bankers are actually doing. They will focus on growth and market share, driven by improvements to the consumer experience, investments in mobile technology, talent retention, brand marketing, and risk management. And the holy grail will always be to do all of this while becoming very cool and popular with the membership of the future found in the Millennial and Gen Z generations. But to be clear, a high percentage of most credit unions' target field of membership is the underbanked, or put differently, those who are financially struggling and underserved. And many, if not most, progressive credit unions, fortunately, will realize the need for proactive service strategies for that group as well. Now, the Filing Research Institute just published a thought-provoking, must-read paper, in my opinion, titled "The Credit Union of the 21st Century." In this report, the Filing team compiled feedback from credit union leaders with academic research to reach several conclusions that relate to credit union strategic planning. First, no matter the service niche chosen by individual credit unions, all credit unions should realize that the credit union of the future should be relationship-rooted, a platform-based concierge approach, and a one-stop shop for financial services. They should also consider investments in ambient banking with a skillful mix of artificial intelligence-driven chatbots and human handoffs, as Filing put it. Second conclusion, dramatic socioeconomic trends and new technological capabilities will change the way that credit unions must approach financial services, and change should happen quickly. The third conclusion, workforce transformations to more part-time and contract workers in a gig economy, growing income volatility and fragility, and increased automation have altered the financial needs of Americans. Fourth, millennials will have less need for traditional branches and much greater interest in a one-stop mobile financial institution. The role of payments is becoming the key entry point into those financial relationships. And number five, changes to credit union laws and regulations will be needed to help credit unions adapt to this new environment and to help them be the community-centric cooperative providers of affordable financial services in the future. Well, that's a lot to take in, but I find it interesting that there's a surprising amount of overlap when considering relevance to both millennials and the underbanked. There are 83 million millennials in the U.S., a quarter of the population, and an estimated 30% of them are underbanked. 21% have never written a check. 27% would consider a branchless digital bank, and they account for over 40% of all retail sales in the U.S. This next generation for credit union membership does not typically place the same value on home and car ownership and other big-ticket items as their parents and grandparents did. So as futurists predict that autonomous cars and ride-sharing will become even more prevalent, credit unions' bread and butter home and auto lending may become hyper-competitive and challenging in the future. And millennials are glued to their smartphones, accounting for 41% of total time that Americans spend on those phones. The Filing study describes the precarious future of work in the U.S. by pointing out that 94% of net employment growth in the 10 years between 2005 and 2015 was in the form of freelance, contract, on-call, or temp agency jobs. And 20% of all workers today are contractors, usually not receiving benefits from their employers. They predict that in the next 10 years, a majority of workers will fit those criteria. And with respect to income volatility and difficulty saving, the Filing report reported that Federal Reserve data showed that 1/3 of Americans reported some kind of monthly income variation in recent studies. Other financial wellness data points reinforce that the underserved in financial services is more the mainstream than a small group. Fully 60% of U.S. households have experienced a major financial shock in the last year, and still 55% could not replace 1 month of income with their available savings. So who's serving the needs and perceived needs of this burgeoning group of underbanked and underserved consumers? Traditional bank and credit union models seem to locate their new branches in more upscale neighborhoods, looking for the moderate to high income household that might be a net saver and more likely to make big ticket purchases financed by their credit union. The old occupational-based offices located close to the core Field a Membership group seems to be a model of the past, or one that is being replaced by these community-based fields of membership and a more diversified and larger group that is served. Nobody can argue with the economic rationale behind these trends, but not-for-profit tax-exempt credit unions also have a social responsibility, obviously, to serve the underserved in lower-income, urban and suburban neighborhoods, as well as through great one-stop mobile offerings that help members with their basic needs of paying someone, getting quick access to money, and saving and protecting their usually small nest egg for the future. The payday lending industry has really only been around in the U.S. since 1993. It's hard to believe, and it has grown to over 15,000 stores in the 28 states where they are legal to operate, with 83,000 employees and serving 12 million customers, mostly low-income and financially challenged borrowers. It's a profitable industry with over $11 billion in annual revenue and $1.4 billion in annual profit in 2018. These providers are most often focused on an excellent consumer experience, believe it or not, in their mostly urban and rural stores, as well as their websites and their mobile apps. While their reputation is poor due to the high fees charged for payday loans, regulations require transparent disclosure and place limits on egregious practices related to rollover loans and collection activities. Most of the big payday loan providers message trust, speed, clear rates and fees, and customer satisfaction. They tout customer testimonials. They cross-sell reloadable Visa debit cards as an alternative to checking accounts, offer faster access to paychecks, provide bill pay and money transfer options, and offer financial education. Many credit unions across the country offer payday alternative loans. For federal credit unions, they model the NCUA-approved and CFPB-exempted PALS program, where members can borrow up to $1,000 for a $20 fee and 28% interest for terms of 1 to 6 months, and with 3 such loans in a 6-month period. The APR on those loans calculates out at 76%, well below the APR rates of the payday lenders. For state-chartered credit unions in states like Michigan, One Detroit is an example of a state-chartered credit union that offers a $70 annual fee, along with an 18% annual rate, and members are allowed to make multiple draws throughout the year for these small dollar loans. A full 17% of this small credit union's membership uses its MyPay loan product, and members pay roughly 1/4 the cost compared to the Detroit area payday lenders. So a great service is being provided for those needs. Now, as the millennial generation shows less and less interest in home, auto, and other big-ticket purchases, and as their credit scores and employment status make it more difficult to be served by traditional loan products, their needs for quick access to money may well be served by credit unions' payday alternative loans like those offered by One Detroit Credit Union and many other credit unions. And then consider the huge influx of the neobanks like Chime, MoneyLion, Varo, Green Dot, and proprietary beta banks like Marcus, owned by Goldman Sachs, Greenhouse, owned by Wells Fargo, and Finn, owned by Chase. Jim Maru, co-publisher of the Financial Brand, predicts that by the end of 2019, over half of the largest 10 U.S. banks will have fully digital mobile banks that provide customers with the one-stop financial services hub that Filene suggests credit unions will need to offer in the future, and many other regional banks are doing the same. Interestingly, these banks realize that the separate mobile product is about creating a different mobile experience that blends financial education, low-fee services, and remote tools for payments, borrowing, and investing, much like the neobanks and other providers that are disrupting the financial services landscape. Many of them will use the Green Dot model of messaging that there are no pesky overdraft fees with the Green Dot product, and provide the ability to get your paycheck up to 2 days early and deposit cash at corner pharmacies at over 100,000 plus locations, while also managing spending using a personal financial management platform. That's the type of mobile experience that credit unions need to invest in and provide as an alternative even if that type of product cannibalizes existing offerings. The takeaway for credit unions is that as the world turns and next generation banking places more emphasis on speed of payments, quick and easy access to small loans, and creative ways to low-cost, trusted saving and investing, millennials and other tech-savvy consumers will demand a different type of banking. And a majority of these new members will be lower-income, underserved consumers looking for the trusted, affordable financial services offered by credit unions. No provider should be better suited to doing this than a credit union. The planning challenge for all will be to answer the question of whether that is where the 21st century credit union wants to go. It won't be as profitable as serving the middle to upper class financial services needs, but it will be more satisfying and more in keeping with the true mission of credit unions. I believe that most successful credit unions will proactively serve all income demographics, but with strong conscious emphasis on the growing needs of the underbanked and underserved, especially millennials. CU Solutions Group has created a new fintech company called LifeStep Solutions, and we plan to explore turnkey mobile offerings for credit unions of all sizes. These will help credit unions meet the service needs of millennials and the underbanked. Features will include mobile payments, short-term small balance borrowing, and resources for financial wellness. We believe that credit unions will need to collaborate and invest together in these types of offerings, and we look forward to sharing the journey with our credit union partners and investors.